All right, guys, we're back again with another great episode of PFREI. I'm your host, Fuquan Bilal. Today we got a special guest, Fernando Angelucci.
Yes, sir.
All right, Angelucci.
So
Let me
right.
inquire real quick. So Fernando is the 28-year-old senior managing partner of Titan Wealth Group, based out of Chicago, Illinois. His first read, Rich Dad, Poor Dad, was when he was 16 years old, and subsequently started his first business at the age of 19 while attending the University of Illinois at Champaign-Urbana. When Fernando graduated with an bioengineering degree in 2013, he went on to work at a Fortune 50 company. Is that correct? Fortune 50?
Yeah.
Okay.
Yeah.
Fortune 50 company, and immediately started investing in single-family homes on the side. By the age of 23, he was able to replace some of his income and exited the 9-to-5 life, began investing in single-family, multifamily properties full-time. By 24, he began purchasing value-add self-storage facilities, and within 2 years, he started pooling funds from his investors to build ground-up Class A self-storage facilities to hold, sell, and publicly trade REITs at asset maturity. So let's start off with the first question, because that's a lot in that one paragraph. From the age of 16 all the way to 29. Wow, you've covered a lot, man.
Yeah.
Congratulations.
Yeah. Thank you. I appreciate that.
So the first question I always ask the guests, welcome to the show, by the way, is why are you passionate for real estate investing?
Right. So, my history kind of starts with my parents. So they were immigrants to this country. They really worked their asses off to just provide a solid home life for me and my brother. And I always saw how much they would grind and grind and grind. And looking at that, I figured there has to be a way to achieve financial freedom without taking 50 years to do it. Right. And so that's when I started reading about real estate when I was 16. And I found out passive income is truly the way to wealth. It's about acquiring assets that kick off positive cash flow. So I went through the whole gambit of doing single family homes and multifamily homes and all that. And, I was still having a lot of trouble with that passive part. What people don't tell you when you buy your first rental home or your first rental apartment is that it's not set and forget it. It takes a lot of work and you have a lot of issues with the tenants. So I was looking for an asset class that was a little bit easier to manage. And that's when I actually came across self-storage. Self-storage is encompassed by lien law as opposed to, tenant law or eviction law. So when someone doesn't pay you, it's a lot easier to collect and get them removed. I'm here in Chicago, the tenant landlord laws here are super tenant friendly and not friendly at all to investors. And it can take 6 to 8 months to get someone evicted out of a unit legally. Self-storage is the exact opposite. Because it's lien law, as soon as you put stuff in my units, I now have a lien on top of that stuff. And if you don't pay, usually within 45 days, I can auction off all of your belongings and recover the unpaid rent. And then the turnover is, 30 minutes, as opposed to having to paint and do the carpeting and, put the property on the market for 2 months and pay a realtor to get it filled. You're losing 3-4 months of profitability just from one turn. Whereas in self-storage, the stuff is auctioned off. I get a maintenance person go in and either blow out the dust or just, shovel or broom, sweep the unit. And within 30 minutes, I have a new tenant in there, paying full market rate. So I really started leaning towards self-storage. And then we've sold basically our entire rental portfolio off and replaced it with self-storage facilities. This last 12 months, we've purchased another 6 facilities. So, and next year we're looking to buy another 14.
Wow.
Yeah.
I'm in the wrong business, man. I feel like a punching bag as you was talking. Like the turnover is 30 minutes, whereas opposed to waiting forever and a couple of grand to paint and change carpet. I'm like, oh.
Right.
That's great, man. I'm glad for you. I mean, I get it. It's tough and challenging, and for people especially for people who's new, who get started, who may hear this podcast or, be intrigued about becoming a real estate investor. They just
Right.
see maybe the other life, the people portray, the shiny objects, the cars, the boats, and everything else. They don't know that this is serious work. Serious work, but it do give you the freedom and time that you want. And if you are successful and setting up the right systems and putting people in place, it can become freedom. If you hire the right property manager, which we all know is very tough to find, but they're out there. Nothing against property manager companies. There are some guys who do the right job and make it easier for property owners. But I kind of like that transition that you went from. So let's get into that a little bit. You talked about a few key points that really resonated with me with the self-storage thingy. So you said that the turnover is 30 minutes. So it's just taking somebody's stuff out, broom sweeping it clean, spraying it down possibly with some, nice deodorizer spray, and then that's it? Like, wow.
Yeah,
So
that's it.
So the due diligence part on what it's about. So you liquidated these assets and you ran across this self-storage. I mean, it's the type of lender that you would find to finance you on that. Was it difficult, and that's why you're trying to transition to finding like private money or doing syndications? How does that go into it? Because residential is just a regular lender, and you go from there.
Yeah, actually, I gave a presentation in Collective Genius about this. It's actually the opposite. Lenders love self-storage. They prefer it over a lot of the other real estate asset classes, and that's because there was a lot of studies that were done by the National Association of REITs, and as well as Intech Solutions. And so here's a couple key stats, right? So when it comes to losses, right? Self-storage is considered a safer loan for a bank than, say, single family or high-risk multifamily. And that, when you look at the data, it's proven. So self-storage across all the real estate asset classes has the lowest number of defaults per thousand. And then of the rare few properties that do default, the amount of loss experienced by the bank is actually substantially lower. So for example, so you're a multifamily guy, right? As when multifamily, so I'm looking at TREP source data here. Multifamily, when disposed, the banks on average will experience a 4.38% loss. Self-storage is at 1.52%. So you're looking at, a magnitude of 3 times less loss towards the bank. So this actually has helped us quite a bit. The last 2 properties we closed with 100% loan to cost. I didn't have to even raise any money. The bank gave us all the money we needed, including funds to do the value add as well, physical improvements. Another thing that I always look at too is when you look at the return over a statistically significant period of time. So let's look at 1994 to 2017. Okay, over that time, you can say that there's probably 2 recessions in that timeline. From 1994 to 2017, multifamily returned on average an annual average return of 13%, whereas 13.3%, whereas self-storage has returned on average an annual return of 17.43%. So that doesn't seem like a big difference, that 4% in return, but that 4% compounding. So if you put $100, or let's say you put $100,000 into the S&P 500 in 1994. In 2017, that 100,000 would be about 532,000. If you put it into apartment buildings, that 100,000 would be about 1.77 million. And if you put them into self-storage, by 2017, that 100,000 would have been $4.02 million. So almost doubling the return over that period, just because of that extra 4% compounding. So when I look at both, higher return, but then also lower downside risk, not only to the investor, but then also to the banks, it basically became a perfect storm for me, and I was sold. I'm a big numbers guy. Analytics are kind of what drive me when it comes to real estate. So let's talk about the bad times, right? So we all lived through 07, 08, 09. I have some historical losses on there.
I was just thinking that you would think that that business would be better because of the foreclosures and people needing places to store their stuff. Right. You would think that business is like almost recession proof. Like what happened?
Yeah. So I wouldn't say that it's recession proof. I'd say more it's recession resilient. So there was a little bit of a loss still experienced, but very slight. So when we look at the National Association of REIT data from '07 to '09, the S&P 500 dropped 22%. The mortgage industries dropped 19.5%. Multifamily, it did a little bit better. It dropped only 6.7, 6.8%. Self-storage, again, this is across all the REITs, right? Self-storage only dropped 3.8%. So half as much drop from multifamily to self-storage. And then when you look at the type of tenant base that you have in times of distress, when people have to either downsize because they can no longer afford their mortgage, or they have to move into a smaller rental because the rent payments they were paying before was too much, they're not going to throw away their kids' drawings that they made for them when they were 2, 3 years old. That's just not going to happen. There's an emotional component. So they're going to look to store that. And when you look at the cost per square foot, it makes a lot more sense to go from a 2,400 square foot apartment down to a 1,200 square foot apartment, and then go rent, a 10 by 10, an extra 100 square feet for an extra $80 a month, because that difference. So the arbitrage in down times, self-storage is one of the things that have stayed pretty steady. And that's one of the things that we're preparing for now in a lot of our equity raises. We're telling a lot of people, hey, there's going to be some turbulence on the horizon here, probably in 18 to 24 months. I need you to put some capital aside that's not going to be affected by the markets, because when that happens, there's going to be a lot of opportunity for us to pick up, brand new Class A facilities that were just built, and we're going to be able to pick them up at cost below what the builders built them out for, because they haven't experienced any positive cash flow. Usually on these ground up developments, especially in the REIT grade space, you're looking at 100 to 120,000 net rentable per facility. That's going to take a solid 36 months from breaking ground to being cash flow positive. But once it becomes cash flow positive, they're cash flow beasts. Your break even rates are much lower than what you experience in other real estate asset classes. We're talking anywhere in if it's unleveraged, 35 to 36% occupancy. If it's leverage, you're talking maybe 66 to 68% occupancy is break even. So if we can get into these areas when the economy is taking a hit, and we can buy these facilities that are maybe in month 12 of lease up or month 24 of lease up, so they haven't broke even yet and these people are feeling the squeeze, that's going to provide a lot of value and equity for my investors. And then once we stabilize it, that cash flow is going to be consistent every month, and it's going to really help weather a lot of storms. A lot of investors, they don't just invest in one asset class, they have a portfolio. So I tell people, if you don't have self-storage in your portfolio already, think about adding maybe 10%, 15% of your available investment capital into self-storage, because that's what's going to help you weather the storm when your office buildings are, not doing well, or your medical is not doing well, or your industrial is not doing well.
Yeah, that's awesome, man. Oh man, I'm ready to take more notes.
I'll send you my last couple collective genius presentations so you can
I appreciate it. I appreciate it. This is good, because kind of give a different perspective of a different asset class in the market. And the main points that you discussed, I'm sure the lenders would definitely appreciate it. When you compare the two versus multifamily residential cash flow versus self-storage. Now, are you guys targeting, because I know you mentioned brand new facilities that will be a bonus to be able to capture some of that when the turbulence come in the market. Right. But what is your model now? Are you buying mom and pop stuff that is going out the business?
So
you at from there?
Yeah, we have kind of three aspects of our business on the self-storage side. So what we started with, and what is the safer of the three, is we purchase value add facilities that are already cash flow positive, but due to management inefficiencies, or because the mom and pops operate as a second business, not their primary business, they're losing a lot of ancillary income. So perfect example is I'll find a facility, it's maybe got an expense ratio of 50%, maybe even higher than that. I'll come in and within 18 months, I'll turn the facility around. I'll raise rents. I'll drop expenses. And then when we come out on the other side, we're usually at a 25 to a 30% expense ratio. Um, the nice thing about self-storage is it's a commercial asset. So it's valued based off of the income generation potential, right? So if I'm buying a property at, call it a 10% cap rate at 50% vacancy, or 50% expense ratio. And then over the next 18 months, I put in a marketing plan, I put in management softwares. I raise the grade of the facility. Maybe I'm buying it as a Class C facility, but then I put in security and fencing, automatic gates, automatic ways for tenants to buy, pay for their units, and even clean them out or access them. I could bring that C grade facility up to a B or a B plus, depending on what I do to it. So now let's say that the going cap rate for a B grade facility is 6% or 8%, in that range, depending on where you are in the geography. And then I've also increased that net operating income by maybe 50 to 100%. I've now created a huge amount of equity. My very first deal, when I was just cutting my teeth, was in a small town in Illinois called Yorkville. We purchased that property at, I believe, a 7 cap. We increased rents by 28% across the board within the first couple months. We dropped a lot of the superfluous expenses that the owner was experiencing. And then so that property we bought for just shy of $1 million. And within 18 months, we increased the value by $600,000 by doing we didn't do anything physical to property. We didn't put in new securities, fencing, anything. All we did was just increase rents, drop expenses, and within 18 months we created over $500,000 in equity, right? So these are things that are very achievable for the newer investors starting out. And I'll be honest, I love teaching people about self-storage. Anytime anybody wants to give me a call, I've been more than happy to sit down for a couple of hours and show you how to do it. But what I found is a lot of people, once they understand that what you're talking about, you have access to the capital, you have access to the debt, you know how to do the management, 99 times out of 100, instead of them just going and doing it themselves, they just say, hey, Fernando, here's a check for $200,000. Why don't you just go put it into your next deal?
Yeah, I get it. I get it. What challenges? I mean, we can all sit here and talk about the great returns and how good the business is, but every business has a challenge. What challenges are you facing in that market, and what are some of the things you're doing to get beyond that?
Yeah, so technology is a massive disruptor in any industry that it presents itself in. Self-storage is one of those industries that, for some reason, it took a long time for technology to really break its way in. So there's still a lot of facilities that are operating on the old school model, and now you have these new companies coming in that they're basically providing a fluid transaction where you never, if you don't want to, you don't even have to interact with a human being. You can go to a kiosk, you can rent your unit, you can rent tenant insurance in a lock, you can use an app on your phone to unlock the doors to get to it, unlock your specific unit and have it, retract up so you don't even have to use your muscle power to open it. And then same thing with the marketing and advertising side. There's now a lot of technology going into that portion of the space that helps with, finding the tenants. Where are they coming from? What are they looking for? What are their habits? What will help you get the sale? So the way that we've been trying to keep up with that is just by, if you can't beat them, join them. We've been putting in a lot of technology into every one of the facilities that we buy. It's one of our very first physical value adds that we'll do after we already get done with, the lowering of the expenses and raising rents and increasing marketing. We'll start putting in technology that allows them, 24-hour access to the facility. They don't have to interact with a human being if they don't want to. If they want to, there's an option to do that. They can get into the facility. They can, unlock their units with their phone. If they have any maintenance requests, they can all put it through their phone. And nowadays everybody does everything here, right? For us, the old school method of self-storage was it has to be on a road that has a lot of traffic because that's how you're going to get your tenant base. Now, over 68% of our tenants come from the very first way they reach us is by searching us online on their phone. They don't even need to drive past their facility. And then it just comes to being, you know, are you competitive and are you offering the amenities they're looking for? Clean, safe, well lit, you know, secure storage facility.
Yeah, I see a lot of people marketing and promoting, a lot of syndicators, self-storage in shopping centers and shopping malls, finding
Right.
some of the big places that went out of business where it's empty space, and they go in there and, you know, maybe buy that section or lease that section for a long term,
Right.
and basically put it there so people could do shopping and go to their storage at the same time, or grocery and go to their storage at the same time. So you guys geographically trying to set up in areas where there's shopping centers or groceries, or where you just find the best?
Yeah, so that's another model that we have. It's called adaptive reuse, where you find these commercial, you know, warehouses, for a better, you know, better term, you know, maybe a Kmart or a Circuit City that went out of business, and then setting up in there. The reason why that's advantageous is you're ready usually these places are on Main and Main, right? They heavy traffic counts. There's a lot of dense population, urban, you know, maybe multifamily housing or planned unit developments. So that's number one. The second advantage of doing an adaptive reuse deal is that you already have the shell. So if you know, on average, it's going to cost me anywhere between $60 to $72 a square foot to do a ground up development. But if I can get a 100,000 square foot Kmart at, you know, 11 to 20 bucks a square foot, and then I could do the interior for 15 to 20 bucks a square foot, now I'm at 40 bucks all in for what looks like a brand new facility, and I just shaved off 20 to 30% of my cost if I were to actually do a ground up development.
That's awesome, man. This is another great episode of PFREI. I definitely appreciate you coming on. Make sure you guys go check them out at Titan Wealth Group. Now, you mentioned something, you know, you spend time with people. We know there's a lot of tire kickers out there, so I don't want you wasting your time with people calling. I know you all about adding value. So you guys, if you catch this, please, this guy have a lot of value to add. If you're serious about doing it and you're just looking for some direction, you know, reach out to Fernando. He'll definitely, you know, extend an olive branch and help you out. What are some other ways they can help you? I know on social media handles is the Titan Wealth Group, and I'm gonna give you a site again. Is it TitanWealthGroup.com? Facebook. They have Facebook here. Social media. Well, that's all the Titan Wealth Group on.
Yeah, just Titan Wealth Group. You can search that. You can search my name, Fernando Angelucci, and you know, I also, my business partner thinks I'm crazy for doing this, but I give away my cell phone numbers on these podcasts. So if you're ready for it, I'll give it. All right. So it's area code 630-408-8090. Again, that's 630-408-8090. And I swear to you, this is my actual cell phone number. It's funny how many times people will call me and they'll think that they're about to get a recorded message, and I say, hey, it's Fernando, how can I help you? Or they shoot me a text message and I respond right away.
Yeah.
So, you know, I just want to provide as much value as I can. And I know especially your listener base, they're a little bit more sophisticated in general, and they will have some pointed questions that I can definitely help them answer, as opposed to spending, you know, hours at a time searching on the internet to find it.
That's awesome, man. Another great episode of PFREI, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. Catch us on Twitter, Instagram, Facebook, and all the other great social media handles. Thanks a lot, Fernando. I really appreciate you coming on.
Talk to you soon.